If you're looking to buy a house and the sudden jump in interest rates from 3% to 7% has got you feeling unsure about whether you should go ahead or not, I've got a strategy that could help you out. So here's the deal. As some of you may know, the Bay Area housing market is very interesting right now. Most of the homes are selling over asking price and are only on the market for just a few days or weeks. But at the same time, not every seller is doing so great. I have been talking to some sellers who have been struggling to sell their properties. And with this strategy, not only as a buyer, you can snag a great price, a lower price for your home, but you can also lower your monthly mortgage payment as well. This strategy will also help the sellers sell their homes much faster. What's up guys, Shar here. Welcome to my channel where I talk about all things real estate, including tips, educational content, and home tours in Bay Area. Before we dive into this video, I'd really appreciate it if you could subscribe to my channel and support this content by giving it a big thumbs up and dropping a comment below. If you've tried out any of these strategies, please let me know. I would love to hear about your experiences. And even if you're new to all of this, I still want to hear your thoughts. So don't hesitate to leave me a comment. Now, if you've been on a house hunt for months, you've probably felt the pinch of those skyrocketing interest rates on your budget. I mean, let's say a year or two ago, you were hoping to buy a swanky $1.5 million dream home. But now you've had to adjust and settle for a $1 million place. Well, this strategy I'm about to spill the beans on could still help you get that dream home. To really make the most of it though, you need to understand how it works and flex your negotiation skills as a buyer. All right, let's dive in. Now, when it comes to buying a house, most people think about the purchase price and the monthly payment. And when properties sit on the market for a while, buyers often believe they have a shot at negotiating a lower price. But let's be real, it's not always easy to convince sellers that their homes are worth less. So how can we find middle ground? How can we make both the buyer and the seller happy? Well, this is where the strategy I'm about to reveal comes into play. By using the seller's money to lower your interest rates, you can actually end up with the lower monthly payment. This strategy is a win-win for both you and the seller, since they can offer a credit to cut down your monthly costs, which might be cheaper for them than reducing the purchase price. As a home buyer, naturally, you would prefer a lower purchase price. But let me tell you, a lower monthly payment is what really matters the most, because that's what you'll be spending most of your money each month. In my experience, buyers value the monthly payment more than the actual price of the property. I mean, think about it. This is not realistic. But if I told you that you could own a $5 million property by paying only $1,000 a month, would the total price still be a big concern to you, or would you be more focused on that $1,000 monthly payment? I've found that most buyers prioritize monthly costs. So let's delve into how this strategy works to see if this is the best approach for you. All right, so here's the deal. Let's talk about using the seller's money to bring down your interest rate. And you're probably like, how does this thing work? What is this whole thing with buying down interest rate? And I'm gonna break it down for you. When you get a loan, they give you an interest rate, right? They tell you this rate when you first get pre-approved. As the buyer, you have the option to pay a little bit extra to lower that rate. That's what we're gonna focus on today. So for the sake of our chat, let's say the interest rate for people who are well qualified is around 7%. But what if you could score a sweet 6% rate by getting the seller to chip in? How would it affect your monthly payment, and why would the seller be even into it? To show you how this works, let's imagine I'm the agent in charge of selling a property that's been on the market for a few weeks now. Now, keep in mind this approach tends to work better for houses that have been listed for a while, not the ones that just hit the market. Sellers like to see how things are going and figure out what they can get for their place. When a property is fresh, convincing the seller to help you out with the interest rate might be a tough sell, but it's still possible. However, if the house has been on the market for a good bit, this approach is more likely to succeed. All right, let's say I'm the agent selling a property listed at $1.5 million. and you're interested in buying it today. For the sake of our discussion, let's assume you're getting a loan for the full $1.5 million. And I know this is not the usual way that things go, but let's just roll with it so we can take a look at some numbers together. If you, as the buyer, lock in a $1.5 million loan with a 7% interest rate, which is the going rate for well-qualified buyers, your monthly payment would be around $9,979. Now, since I'm the agent and the property's been sitting for a while, I've already been talking to the seller about potentially lowering the price to match with the current market trends. This price cut shows that the sellers are serious about finding real buyers. With that in mind, I would suggest dropping the price to about $1.4 million, which is a $100,000 discount. So instead of getting $1.5 million, the sellers now would be receiving $100,000 less. As the buyer, your goal is to snag the property at the lower cost while keeping your monthly expenses in check. If you manage to convince the seller to knock the interest rate down from 7% to 6%, not only does that shrink your monthly payment, but it also saves the seller from having to lower the price by $100,000. Win-win, right? So here's the deal. Imagine this situation. When you're making the deal, you ask the seller to cover 3% of your closing costs in the contract. This way, you can use that money to get a lower interest rate. Let's say you're taking out a $1.5 million loan. That 3% comes out to be $45,000, so let's just say $50,000 for easier math. If you apply that to your interest rate, it can go from 7% down to 6%. And guess what? Your monthly payment goes from $9,979 to $8,993, saving you $986 every month. Now, here's the thing for the seller. They cover $50,000 closing costs. As a listing agent, instead of recommending a $100,000 price reduction to the seller, I suggest we explore other options, like helping the buyers get a lower interest rate. That way, the buyer gets a lower monthly payment without spending any extra cash. You might be wondering why not ask for more than 3% towards closing costs. Well, it's possible to request 5% or even more, but that depends on finding a seller who's willing to play ball. In this example, where the property has been sitting on the market for a while, reducing the purchase price by 3% doesn't have a big impact. As a listing agent, I need to show the seller that this approach is in their best interest in this current market. So we're using the seller's money to lower the rate for your benefit as the buyer, which in the end will also help the seller sell their property. Now, you might think it's better to get a $100,000 price reduction instead of a rate buy down. But hold on, let's do the math using the same example. If you reduce the purchase price by $100,000, your monthly payment would only go down to $9,413. On the other hand, if you ask the seller to pay down the rate, your payment would drop to $8,993 per month, giving you much bigger savings. So sticking to the original purchase price and requesting credit from the seller gives you much bigger savings, my friend. Now, you might be wondering why you need the seller to buy down the rate instead of doing it yourself. Technically, you don't really need them to do it, but there's a benefit to it. If the seller picks up the bill, it means you don't have to pay as much out of pocket when you decide to buy down the rate. You see, when you pay those discount points to lower the rate, it's an extra cost that you won't get back. But if interest rates go down in the future and you want to refinance, you can take advantage of that without worrying about the money you initially spent to buy down the rate. Since it's the seller's money used to lower the rate, you don't even have to think about it because it wasn't your money in the first place. And hey, considering the expectation of lower interest rates in the future, I wouldn't recommend using my own money to buy down the interest rate in this market. It'd be great if interest rates drop, but banking on that when buying a house isn't a reliable approach. It's much better if the seller has already taken care of buying down your rate, so you don't have to worry about refinancing if the rates go down later. Oh, by the way, this strategy isn't just limited to existing homes. You can also apply it to new construction. Builders are often open to these kind of arrangements, especially when the market is changing. They want to sell their properties and explore more creative options. And you know what? Sellers in this market could be in the same boat. With more homes up for grabs, properties might stay on the market for a while, making the sellers more open to alternative ideas. Maybe you want to use the funds to cover your closing costs instead of dropping the interest rate. Regardless of what strategy you choose, it's super important to have a reliable real estate agent and a lender guiding you through the process. If you need any help with that, feel free to hit me up with the contact information I've provided. I can hook you up with an amazing lender who I like and trust, who can guide you through the whole process. Disclaimer, keep in mind that this approach might not always work. It depends on a variety of factors like where you're in the market, how quickly homes are selling in your area, and would it make sense to ask for a price reduction or a rate buy down credit. And also, you've got to have a seller who's willing to work with you. In our market in Bay Area, right now, as of September 2023, it's not really a seller's market, even though inventory is very, very low. It's a pretty normal market. At the same time, most sellers are selling over asking. So you want to make sure that you have a pretty strong and clean offer to get the house that you want. But that also changes from one city, one location to another. It's imperative for you to have a listing agent that understands how this strategy works. And also you as a buyer need to understand how this works. And in some cases, it may not even be the best deal for you because maybe they're only willing to give you a 1% or 2% credit, but it all comes down to negotiation and having an experienced real estate agent professional as well as an experienced mortgage professional on your side. Because if you do get the seller to work with you, you've also got to have a mortgage professional that understands how to fully put together that loan and also to be able to explain to you how the buy down works so you can fully get it on paper. At the end of the day, you need to take a look at your own current living situation, regardless of what's happening in the market, whether the rates are high, whether you can secure a good deal or not. And these are just tips for you to keep in mind so you know your options and you can make the best informed decision for yourself and for your family. And that's a wrap for today, guys. Please don't forget to subscribe to my channel and turn on the bell notifications before you leave. I really appreciate you for watching my video and I hope to see you again real soon. Have an amazing day. Bye-bye.